to invest in stocks for teens or beginners. Welcome, fellow adventurers, to the realm where fortunes are made, dreams are woven, and legends are born. Ever wished you could own a piece of that billion-dollar company? Or maybe be the Sherlock Holmes of Wall Street, deciphering cryptic clues that can lead to a treasure trove of wealth? Well, buckle up, as we are about to embark on an epic journey through the exhilarating world of stocks. Whether you're a teenager looking to buy your first share or a beginner eager to unlock the secrets of the financial markets, this is your gateway to untold riches and knowledge. Prepare to time travel, unmask hidden gems, and build your very own empire of wealth. Get ready to unleash the investor within. Grab your maps and gear as we set sail on this ultimate adventure. This is not your ordinary guide. This is how to invest in stocks for teens or beginners. Your epic saga waiting to unfold. First, let's address the big question. What are stocks? Imagine owning a piece of your favorite tech company or the popular soda brand you love. Stocks are essentially ownership certificates of a company. When you own a stock, you own a tiny fraction of that company. Companies issue stocks to raise money for various reasons: research, development, expansion, or even paying off debt. The combined value of all the stocks represents the market capitalization of the company. Now, why should you, as a teenager or beginner, be interested in stocks? Investing in stocks can be a powerful way to build wealth over time. As the company makes profits, the value of the stocks tends to increase. You can make money by selling the stock at a higher price than you bought it, or through dividends, which are a portion of the company's profits distributed to shareholders. However, stocks can also be risky. The stock market fluctuates due to various factors: economic trends, political events, natural disasters, and much more. The key is to make informed decisions and be patient. Before you even buy your first stock, there's some groundwork to be done. First, educate yourself. Read books on investment, follow market news, and maybe take a course or two. Some classic books to consider are The Intelligent Investor by Benjamin Graham and Rich Dad Poor Dad by Robert Kiyosaki. Next, set your investment goals. Are you saving for college, a car, or just looking to build wealth over time? Your goals will determine your investment strategy. For short-term goals, you may not want to take much risk, while long-term goals might allow for more aggressive investments. Now let's talk about setting up an account. As a teen, you'll need a custodial account, which is an account a parent or guardian controls until you reach the age of majority. If you're over the age of majority, you can open an individual brokerage account. Do some research to find out which brokerage suits your needs. Look for low fees, a good reputation, and tools and resources for beginners. With an account set up, it's time to talk about budget. It's important to never invest money you can't afford to lose. A good rule of thumb is to start with a small amount of money and gradually add to your investments over time. Now on to the exciting part: picking your stocks. This is where your research really comes into play. Look for companies that have a good track record, a solid business model, and room for growth. Don't put all your eggs in one basket. Diversify your investments across various industries. Understand the two fundamental investment strategies: fundamental analysis and technical analysis. Fundamental analysis involves evaluating a company's value based on its financial health, competition, and other factors. Technical analysis, on the other hand, involves studying market statistics and charts to forecast future price movements. As a beginner, it's good to focus on fundamental analysis and gradually learn technical analysis as you gain experience. Another approach to consider is investing in exchange-traded funds, or ETFs, or mutual funds. These funds pool money from many investors to buy a diversified portfolio of stocks. It's a way to own a small piece of many stocks, and can be less risky than owning individual stocks. Once you've picked your stocks and made your investments, be patient. The stock market can be volatile, and it's easy to panic when prices drop. Remember that historically, the stock market has tended to go up over the long term, despite short-term fluctuations. Keep a close eye on your investments and the market. Read company earnings reports, keep up with industry news, and be prepared to make changes to your portfolio if necessary. But avoid the temptation to constantly buy and sell based on small market movements. This is known as overtrading and can erode your gains through fees and poor decision making. Lastly, always keep learning. The most successful investors are those who continue to learn and adapt. Join investment clubs, participate in online forums, and never be afraid to ask questions. Now, let's kick things up a notch with some quirky insights and unexpected strategies. Have you ever considered being a thematic investor? It's like being the superhero of the investing world, swooping in and saving the day by aligning your investments with trends or causes that are near and dear to your heart. Are you a tech wizard who breathes gadgets? Focus on emerging technologies. Maybe you're an environmental warrior? Then consider investing in green energy stocks. Aligning your investment choices with your passions not only adds an element of fun, but can also be very profitable, as you're more likely to have in-depth knowledge about those sectors. Another intriguing avenue to explore is the world of micro-investing. Imagine if you could invest in stocks without having to buy an entire share. Enter fractional shares. Some brokerages let you buy a piece of a stock with as little as $5. Want to own a slice of that super expensive tech stock? Now you can. It's like buying a single slice of pizza instead of the whole pie. Now, let's dive into a treasure trove: dividend reinvestment plans, or DRIPs. If a company is handing you dividends, then why not put them back to work? DRIPs are your magic wands that automatically buy more shares of the stock with your dividend money. It's like planting the seeds of a money tree and then using the fruits to grow more trees. While we are talking about growing money trees, let's not forget the spell of compound interest. It's what Einstein allegedly called the eighth wonder of the world. The concept is simple. As your investment earns money, these earnings are reinvested to generate their own earnings. It's a snowball effect. Your capital rolls down the money hill, gathering more and more until it becomes an avalanche. For some fun social flair, delve into the world of social trading platforms. These platforms allow you to peek into the portfolios of experienced investors and even copy their trades. It's like being in a class where you can see everyone's answers, and you can choose to copy the ones that resonate with you. To wrap this up, investing in stocks can be an empowering journey. It's an opportunity to be part of the businesses you believe in and grow your wealth over time. Start with solid research, make informed choices, and be patient and disciplined in your approach. Remember that while investing carries risks, it can also be incredibly rewarding. Remember, investing is not just about charts and numbers, it's an art. It's a way to connect with the movers and shakers of the world, be a part of something bigger, and create your own financial painting. Be the Da Vinci of your financial life, and maybe, just maybe, you'll create a Mona Lisa that generations will admire. Thank you for watching. If you found this video helpful, don't forget to like, share, and subscribe for more insightful content. Happy investing!